Well, economists are not only worried about slowing growth in China, but also the rise of what's called a shadow banking system there.
There are shadow banking systems in trouble.
It's exacerbated it quite a lot. I've been getting into trouble recently for referring to pension funds as a form of shadow bank.
Chinese authorities have launched an investigation into one of the country's largest shadow banks, Zhongji.
Reducing the size of the shadow banking sector.
Have you ever used a service that lets you buy something now but pay later? Or taken out a loan from a company that's not your bank? If so, you've probably interacted with something called a shadow bank, even if you didn't realize it. Hi everyone, it's Kyle. Welcome back to No BS Investing. Today, we're diving into the world of shadow banking, what it is, why it matters, and the risks involved. By the end of this video, you'll know exactly what shadow banking is and how it impacts your life, even if you've never stepped foot in a bank. So what exactly is shadow banking anyway? Why do these entities operate outside of traditional banking? And what are the consequences for the financial system and everyday people like you and me? Let's dive in and explore the answers together. First things first, what exactly is shadow banking? The term shadow banking might sound a bit spooky, but it's not a bit shady back alley deals. It's actually a term used to describe financial activities that look a lot like what regular banks do, like lending money or managing investments, but with one big difference. They're not regulated like banks. Let's break it down with a simple analogy. Imagine you have a lemonade stand, that's our shadow bank, and a big grocery store, that's our traditional bank. Both sell lemonade, but only the grocery store has to follow strict health codes, get permits, and be inspected regularly. Your lemonade stand, not so much. That's kind of how shadow banks work. They do a lot of the same things as traditional banks, like giving out loans or managing money, but they don't have to follow the same rules. So, what kind of companies are we talking about? Before we get into that, please give this video a like, subscribe, and leave a comment below for the YouTube algorithm. Alright, shadow banks include things like finance companies, hedge funds, peer-to-peer lenders, basically any financial institution that offers services similar to a bank but isn't technically a bank. And here's why this matters. Traditional banks are heavily regulated by governments to ensure they don't take on too much risk and to protect customers like you and me. These regulations include things like reserve requirements, which are rules about how much money banks need to keep on hand, and deposit insurance, which protects your money if a bank fails, like FDIC insurance. But shadow banks don't have to follow these rules, meaning they can take on more risks, and sometimes those risks can have serious consequences for the economy. According to Investopedia, shadow banks operate in the shadows because they aren't subject to the same transparency or oversight as traditional banks. This allows them to offer services like credit or investment opportunities with more flexibility, but also with less protection for consumers. Now that we know what a shadow bank is, let's talk about how it shows up in our daily lives. Shadow banking might sound like something that only affects Wall Street, but it's actually much closer to home than you might think. Here are some common ways that shadow banking shows up in everyday life. First up, mortgages. Some companies provide mortgage loans like a traditional bank, but they aren't regulated in the same way. These non-bank mortgage lenders sometimes offer more attractive terms or faster approvals because they just don't have to jump through all the same regulatory hoops as banks. However, this also means that they might be taking on more risk, which can lead to more problems down the road if the housing market takes a downturn. The IMF, or the International Monetary Fund, points out that these non-bank mortgage lenders played a significant role in the 2008 financial crisis by engaging in risky lending practices. When too many people couldn't pay back their loans, it triggered a wave of defaults that eventually led to the collapse of major financial institutions. Next, let's talk about buy now, pay later services like Affirm, Afterpay, or Klarna. These companies let you buy something today and pay for it in installments over time, usually without any interest if you pay on time. It's super convenient, right? But it's also a form of shadow banking. These companies are lending you money, but they're not regulated like a traditional bank would be. According to Payments, the rapid growth of buy now, pay later services has regulators worried, especially as more and more people rely on these services to make everyday purchases. If people start falling behind on payments, it could lead to a cascade of financial problems for both consumers and the broader economy. And let's not forget about personal loans. Some online lenders make it really easy to get a loan without ever stepping foot in a bank. These lenders can offer fast approvals and less paperwork, but they're also operating in shadow banking sector, meaning they're not as tightly regulated. This can lead to issues like higher interest rates or less protection if something goes horribly wrong. Shadow banks aren't just a local thing. They're a global phenomenon. In fact, they manage trillions of dollars worldwide. The International Banker notes that as of 2024, shadow banking represents a significant portion of the global financial system, with shadow banks holding more than $50 trillion in assets. That's a lot of money moving around outside the traditional banking system. So, all shadow banks provide a lot of services that we use every day. They also bring a lot of risks. Let's talk about those risks more now. Shadow banking offers convenience and flexibility, but it also comes with significant risks. Risks that can affect both individuals and the entire financial system. One of the biggest risks is the lack of regulation. Since shadow banks don't have to follow the same rules as traditional banks, they can engage in risky behavior that might not be allowed otherwise. For example, they might charge really high interest rates on loans because there's no one around to stop them. And if something goes wrong, like if the company goes out of business, you might not have the same protections you would with a traditional bank. T. Rowe Price highlights that the lack of regulation also means that shadow banks can grow very large and interconnected with the rest of the financial system without anyone fully understanding the risks they're taking on. This was a key factor in the 2008 financial crisis, where the collapse of shadow banks like Lehman Brothers had ripple effects throughout the global economy. Leading up to 2008, many of these shadow banks had taken on huge amounts of risky mortgages. When these mortgages started to fail, it created a domino effect. Because these shadow banks weren't as tightly regulated, their failure led to a much larger financial collapse. It's a stark reminder that when shadow banks take on too much risk, it can have devastating consequences. But the risks aren't just historical, they're very much present today. For instance, as shadow banks have grown, they've also become more intertwined with traditional banks. Traditional banks have increasingly turned to shadow lenders for financing, with banks' debt to shadow lenders now exceeding $1 trillion. This means that if a shadow bank fails, it could drag down the traditional banks with it, potentially leading to another financial crisis. And this brings us to yet another major risk: how shadow banks get around regulations. So, how do shadow banks get away with operating outside of traditional banking regulations? The answer lies in regulatory loopholes and financial innovation. As Investopedia explains, shadow banks often structure their activities in ways that technically keep them outside of the purview of banking laws. For example, they might use complex financial instruments like securitization, bundling loans together and selling them as investments, kind of like in 2008, to avoid direct regulations. This process allows them to move risky assets off their balance sheets and into the hands of investors who might not fully understand the risks they're taking on. It's kind of like finding a clever way to avoid the rules. Imagine if your lemonade stand figured out a way to sell lemonade in a bottle that technically doesn't count as food, so you don't have to follow the same health regulations. That's essentially what the shadow banks do. They innovate to stay one step ahead of regulators. The IMF also notes that shadow banks often operate across multiple jurisdictions, making it harder for any single regulator to keep track of what they're doing. This global reach means that shadow banks can exploit differences in regulations between countries, further complicating oversight and increasing the risk of financial instability. So, while shadow banks might just seem like they're just another part of the financial system, they operate in ways that can create serious risks, both for the economy and the individual consumers. Let's quickly recap what we've covered. Shadow banking refers to the financial activities done by non-bank entities that look like traditional banks but aren't regulated in the same way. While these shadow banks provide convenience and flexibility, like offering loans or investment opportunities, they also carry significant risks. These risks stem from their lack of regulation, their potential to create financial instability, and their ability to exploit regulatory loopholes. Shadow banks operate in the shadows of the financial system. While they might seem like a great alternative to traditional banks, it's important to understand the risks before diving in. Whether it's taking out a loan or using buy now, pay later service, knowing what you're dealing with and the potential risks can help you make better financial decisions. Now that we've discussed these critical economic signals, the next important step is knowing how to prepare for a possible recession. If you want to learn actionable steps to safeguard your finances and even thrive during tough economic times, check out my video here, or maybe here to learn more. If you found this video helpful, don't forget to like, share, and subscribe for more content like this. And if you have any questions or want to learn more about financial topics, drop a comment below. I'd love to hear from you. Thank you.